Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, November 10th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we see futures are a little bit higher. We got the Dow Jones futures up about 28 points, S&P up 6, NASDAQ futures up 38. So NASDAQ doing a little bit better on a relative basis, although NASDAQ stocks have been hit relatively hard over the course of the last 5 or 6 weeks or so. Crude oil prices this morning down about 30 cents a barrel to about 85.5. The U.S. 10-year Treasury yield down 6 basis points, 4.09%. This is all in anticipation of one of the biggest economic reports of the month. We have the October CPI report that's due out at 8:30 this morning. Of course, by the time you're listening to this show, it will be out and could make a huge difference in what we're seeing right now in terms of the futures. The market could go either way in a big way, depending on how those or how that report comes out. I think anything below about, from a core CPI perspective, anything below maybe 0.5%, I think would be pretty well received. I think the market has been building in a lot of negativity. A lot of the growth stocks have been hit hard going into this report. So I think anything on that's a little bit more dovish certainly would help that area of the market. Meanwhile, though, I think we get a reading much above that 0.5%, 0.6%. That would likely not be received as well for or by the market. So that's what we're looking at this morning. We'll see how that comes out. Of course, again, by the time you're listening to this, you should have that information in hand, and who knows where the market will be later today. But we do want to watch some key support levels, and we'll talk about that in just a bit. This morning, the agenda will be daily market recap, talking technically, small caps, key stocks, earnings spotlight, and the 3 you must see. Before we get into any of that, let me take you over to earningsbeats.com. If you go to earningsbeats.com, first of all, we have a big fall special starting on Saturday. Great time to come on board as a trial member. First of all, it's free for 30 days. But second, if you do like the service and you enjoy it, you want to keep it for the course of a year or longer, this is our best deal of the year starting on Saturday. So again, check us out. You can start your no-cost 30-day trial by clicking that green button, and you will have an opportunity to sign up over the course of the next week or two for that fall special. One question we always get is, if I sign up for the 30-day trial and in the middle of the trial I decide to take you up on the fall special, do I still get the rest of my 30 days, or do I lose it? You absolutely get the rest of your 30 days. The fall special will be added on to the end of your 30-day trial. I want to make sure everybody's clear on that. Also, if you scroll down, you'll find an area where you can sign up for our free Earnings Beats Digest newsletter. This is published 3 times a week, Mondays, Wednesdays, Fridays. Normally out around 8:30 in the morning. We try to get it out about an hour before the market opens. It's a very quick, simple read, normally 2 paragraphs in a chart, dealing with things that are important to us, like earnings, gaps, candlesticks, trend lines, moving averages, those sorts of things. Of course, price volume, our number one indicator. But we do focus a lot on earnings and relative strength. But I think you'll enjoy it. No credit card required. You can unsubscribe at any time. All it takes is a name and the email address. Also, it gets you an invite to any of our free events. Anyone who's on our EB Digest is invited to all of our free events. All right, daily market recap. What happened on Wednesday? Well, you can see there was a lot of red. The Dow Jones right here down 600, almost 650 points, back down to 32.5. Of course, the Dow has had a huge run of late, making a big run from below 30,000 up to above 33,000. So a little profit taking there. S&P 500 down about 80, 37.48. The NASDAQ down 263 points, though, back to 10,353. Small caps, mid caps, both down more than 2%. So you can see pretty much across the board, somewhere, in that 2 to 2.5% range is about where we saw the major indices. Finally saw the VIX move up a little bit. The VIX has been down, has not really budged to the upside, even when the market was struggling a little bit coming down. So I think that's a good sign for the market. As fear comes out of the market, you tend to handle bad news better. Well, we're going to find out how that theory holds if we get any bad news this morning. But the VIX being down, 8-9 points from where we were at recent market lows, that's a pretty good sign to me. Market makers are willing to price options going out the next 30 days cheaper than what they did before. That's normally a sign that the market is getting healthier, but hard to argue that we're healthy given the way the indices still look. Let's move on. Look at the 10-year Treasury yield, which currently is, as I said, not really reflected on this chart just yet, but the 10-year Treasury yield is down to about 4.09 this morning. The 20-day is at 4.05, and we've been holding that really since back in the first half of August. So watch that 4.05 level. If we get a big break below that, we do have a negative divergence in play, which would likely lead to at least that 50-day test, which would be down at 379. Also, the recent low is one that I would watch, 360-ish, and then, of course, the breakout 350. So you got 350 breakout level, 360 recent low, and 379 is the 50-day moving average. That would be the area for, if you're looking for perhaps a bounce in the stock market and a pullback in the 10-year Treasury yield, that would be the range, somewhere between, let's say, 350, 380. Further it goes down, probably the bigger bounce we would see on the NASDAQ. If, however, the inflation report is hot and we spike, then we're going to want to watch that top, which was at 433 back on October 21st, a breakout above 433 with any gusto, and I think we're going to see a breakdown on the NASDAQ in particular. S&P and Dow, especially the Dow, has a lot of room now to the downside, and I'll show you those two charts in just a second. Start with the S&P 500. So for talking technically, I always like to start with the major indices. Here we've got the S&P 500, which clearly has been trending lower. I mean, you can see a series of lower highs, lower lows. There has been, or there was, a lot of positive rotation back over the summer. That has now, it's gone. We have seen breakdowns across many of my sustainability ratios. The only ones really that are holding up right now are small caps, the small cap growth versus small cap value, and mid cap growth versus mid cap value. And I'll show you a little bit about the small caps in just a little bit. But anyway, here is the S&P 500. We did close back down below the 20. Right now, I would just call this a little bit of a trendless market environment. Anytime you go above the moving averages, back below, back above, back below, back above, back below. Normally, the moving averages provide us support during uptrends or resistance during downtrends. Right now, it's providing us neither. We've got the S&P 500 simply going sideways. PPO right near the center line. It's trying to make up its mind which way it wants to go. We've got some parts of the market that look horrible. Technology, consumer discretionary, communication services. Communication services has looked horrible for a long time now. But the other two have had their moments to the upside, but they currently are looking down. However, other aggressive areas, industrials and financials, are looking much better. And that's what's causing this sideways action, the market not quite knowing which way to go. But the more aggressive areas that I like to follow are not performing well right now. And that going into the CPI report tells me that the market is being very cautious heading into this report. All right, so S&P 500, though, 3,500, actually the candle body low. This was actually the low or the low open, low candle body the last time the CPI report came out. September CPI came out on October 13th, and this is when we had the big gap down to 35.20 and then that big recovery. So 35.20 is your level now as support on the S&P 500. The intraday was 34.91, but I would still be looking to see, make sure we hold the 35.20 area on a closing basis or on opens. We don't want to see gap downs below that level. Upside, 3,900. I mean, I think that's really clear. We've had so many tests, so many pivots at that 3,900 level. I would view any kind of a breakout above 3,900 as a very, very bullish move. And if the CPI report comes in tamer than expected, we could see that kind of a move. Doesn't look like the market's expecting that, but sometimes we get the unexpected. The NASDAQ 100 index, you can see much more painful here. We've been struggling to get back above that 20-day moving average on that low with the gap down back on October 13th. That low open was 10,481. We're at 10,797. So we're only 316 points away. 3% is just a bad day. I mean, we've seen plenty of 3%ers or more on the NASDAQ throughout 2022. Hard to say what might happen if this report is hot this morning, but watch 10,481 on the NASDAQ 100. That'll be a key area. All right, small caps versus the S&P 500. Just want to point this out. I mean, you can see the double bottom we had February and April, small caps versus the S&P 500. And then you can see the triple top right here. Just broke out above that the end of October. So on a relative basis, money is rotating more into the small caps than the S&P 500. Don't want you to get the wrong impression, though, here. Yes, small caps are outperforming, but let's pull up the S&P 600 small cap index, the absolute chart, and you'll see very similar chart. I mean, we're trending lower lows, lower highs throughout the year. So while there's a subtle move toward small caps on a relative basis, the absolute chart still doesn't look much better. I mean, you can argue maybe some sort of a head and shoulder, short-term bottoming head and shoulder right here off of this move, left shoulder, neckline, head, right side of the neckline, right shoulder. A breakout above about 1210 would be really bullish. I think bigger picture, we could probably go out. Let's stretch this chart out maybe 2 years. And I think if we do get that breakout above this 1210 area, what we could be looking at longer term is a left shoulder, neckline, lower low to put in a head. And if we break through 1210, we could run for 1300. That potentially could put in the right side of a neckline from a longer term bottoming perspective, and then maybe a pullback to establish a right shoulder. I'm just pointing out possible patterns. I don't know how this is going to play out, but you need to be aware of both the bullish and the bearish scenarios. And that would be one of the bullish would be breaking out above that key neckline. Of course, to the downside, if we break below this recent low, starts to not look like so much of a, certainly wouldn't be a symmetrical bottoming head and shoulder pattern if we were to lose about 1140 to the downside. That's only 1.5% away. So things could turn ugly as well. This report today is going to be big, potentially going to be big. Let's move on. I want to go into a relative rotation graph and really talk a little bit about these small caps. So what's going on with the small caps? Why are they outperforming? Well, first, let's just show that they are outperforming here on an RRG chart. This is the SML, so that's the S&P 600 small cap index. And then Principal has ETFs, a number of small cap ETFs. The PSC is a widely diversified small cap ETF. Diversified in the sense that their top 10 holdings are less than 8% of the entire ETF. There's only one stock, I think it's H&R Block, that is more than 1% of the entire ETF. So it is a very widely diversified ETF. And you can see the small caps, the PSC, doing extremely well. Right now, I'm doing this relative to the S&P 500. And we're way over here. This is the from left to right going horizontally. This is the relative strength axis. So relative strength is very good. Momentum, relative momentum. Remember, this is a relative chart. So we saw the PSC going down. I wouldn't say that their momentum is strong, their relative momentum is strong. Again, if you go back and you look at the PPO, the relative PPO. This is the small cap index versus the S&P 500. So relative momentum is strong. The absolute momentum is above zero, but not nearly as strong. So that's just want to make sure that that point is understood. So we're talking about relative strength, relative momentum. PSC is doing very well in both. So let's break down another RRG chart. Let's look at the various PSC ETFs. So you have PSCE, you've got energy, utilities, staples, technology, discretionary financials, materials, and healthcare. Those are the ones that are showing up right here. And you can see this is a daily, a 1 year daily, and it's got a 5 trading days tail length. And so what this means, you can see this PSCC, there are 5 dots, 1, 2, 3, 4, 5. Actually, we start here. So it's really 1, 2, 3, 4, and then 5 is where we closed yesterday. It's just showing us over the last 5 days, how has consumer staples been performing relative to just the PSC in general. So I would say that the PSCC, consumer staples, is the short-term leader in small caps, which is kind of interesting because we're going into this big CPI report. So I think what you can see is that, definitely we're a little bit more defensive. In the meanwhile, look at what's going on here with technology. The last 5 days, we've gone from slightly leading on a relative basis and with decent momentum, but look at the momentum shift and go down. And now we're on the lagging side of this horizontal zero line. We're over here on the left side, or of the vertical, vertical axis. So we're on the left side of the relative strength now, underperforming in terms of relative strength. Also below the momentum line. So we're in the lagging quadrant on a relative basis. Technology not doing well. Utilities have not been doing well. Healthcare, small cap healthcare, not doing particularly well. But financials, nice. Industrials in that leading quadrant, nice. Consumer staples, nice. Energy has been underperforming the last 5 days in terms of momentum. Remember, this is the momentum. So we're going down in momentum, but we're still way out here to the right in terms of relative strength. So energy is where we've been doing particularly well. So let's pull up a couple of these charts. First, we'll start off with, let's look at the financials, industrials, staples, and energy. So let's start with the staples, which showing a lot more strength right now. So the PSCC, and you can see we made a big move up, struggling to get above some recent highs though. So you can see we're tried to get through that 108.50 area, did so intraday and then failed, coming back down yesterday. But the market was down yesterday. So on a relative basis, relative to the small caps, it kind of held its own, down 2.5%. Remember, everything was down between about 2.5% yesterday. So consumer staples failed on the breakout, came down, but basically just came down with the overall market. Let's look at PSCE. So here's energy. Energy recently made this breakout above the August high. Small caps, again, small cap energy. Coming back down, testing the 20-day moving average. Yesterday was a brutal day, though, down almost 7%. So a big underperforming day in the PSCE. But overall, it's been pretty good relative to what the market's been doing. I mean, look at this is where we were back at the beginning of the year at 7. Even with yesterday's 7% decline, we're at 10.5. We're up 50% this year on the PSCE. So small cap energy has been a solid area for sure during 2022. PSCF, financials. So financials have started to strengthen. And of course, we know financials did well in October. And you can see small cap financials also did very well in October, and they came down to start November, but then right back up again. We'll see whether or not we continue to hold this recent low, which is also right about the 50-day moving average. So that'll be an interesting one to watch. And then PSCI also showing a lot of strength in the month of October. Pulled back early November, now in this range. We'll see if we can hold. If we roll back over again, that's not going to be a good sign. Close back below 86 would start to look like the downtrend is beginning again. But right now we have a nice uptrend. We're above the 20-day, which is above the 50-day. PPO is positive. All of this is bullish, is a bullish pattern, bullish development in the market. But does it hold? We've seen this before. We saw it back in July and August, and we failed. Most of that had to do with the Fed and also with the inflation reports, especially the CPI. So that's a quick look at some of the small caps. But small caps have been outperforming, but small caps have not exactly been strong. They've just been showing some nice relative leadership of late. And this, I think, the small cap 600 versus the S&P 500, I think illustrates this as well as any of the charts I showed you. Nice breakout here to a 2022 high. This is the best small caps have looked versus large caps in the entire year. So we'll see whether or not that continues, but it's been a very, very strong last 6 weeks or so. Okay, let's move on now to the key stocks. So what I wanted to show you in key stocks, first of all, it's important to understand the stocks that really drive the major indexes. If you follow the S&P 500 or the spider tracks the S&P 500, or if you follow the NASDAQ 100, then you know the QQQ tracks that. It's been a pretty rough year. Well, these major indices are only going to go so far if their top components are not performing well. And right now, I think it's pretty clear to say that their top components are not performing well. I'm going to start off first. Let's move to a weekly chart. I want to get a longer term perspective on these charts, but let's start with Apple. Apple is almost 6% of the S&P 500, and it's more than 11% of the NASDAQ 100. Here is a weekly chart. I think it's pretty clear you don't want to lose that 130 level on a closing basis. 128, 129 intraday. That was the low we saw back in June on Apple. It's been a rough period of late. We don't want to lose, and we're getting close. And we got a big CPI report. Apple's had a very rough stretch the last week and a half. Microsoft, 5.5% of the spider and over 10% of the NASDAQ 100 or the QQQ. I think it's pretty clear this is an ugly chart. It's trending lower. The PPO is setting a new low, pointing down. Momentum is against Microsoft. It's pointing to the downside, and you can see failures at that 20-week moving average. That's the definition of a downtrend. Microsoft right now is trending lower and is showing no signs of slowing. Google, same thing. Failure. We got through the 20-week moving average for 1 week and then right back down below. Otherwise, really since April, this has been a very, very poor performer. You can start pointing to some support in the upper 70s, low 80s, but right now the PPO is not showing us any signs of letting up to the downside. So Google not looking good. How about Amazon? Amazon did get up to the 50-day, got back up to a price breakdown near 140, and now is just completely reversed, turned back down. Volume is accelerated. Got a big support area coming in at about $82, $83. We'll see whether or not that holds. But Amazon certainly in free fall mode right now. By the way, Google, 4% of the spider, Amazon, 4% of the spider, and they're both roughly 8% each of the QQQ. Facebook, or well, Meta, sorry. Let's go back, actually, go back to that weekly chart. Meta might be the worst of all these. It's just absolutely horrendous. I see nothing on this chart worthwhile except just incredibly oversold. So you could get a bounce yesterday with the recent announcement of layoffs. We saw a little bit of a bounce. I don't expect that to last for very long. Meta is about 2.25% of the spider and about 4% of the QQQ. Tesla yesterday broke down on a closing basis below the lows in March and May of 2021. The breakout that has not been tested was down closer to 150, 160. Tesla, unless we get some really good news from the CPI, looks like it's poised to go back down and test the 150, 160 area. And I owned it, got stopped out, excuse me, got stopped out yesterday when these lows did not hold. Last one, NVIDIA. NVIDIA going straight down, coming back up, testing its 20-week, but right at resistance. PPO is still very negative, showing me nothing really. So I think NVIDIA looks poised to simply turn around and go back to the downside. So Tesla, 1.5% of the spider, 4% of the QQQ. NVIDIA, 1.33% of the spider and almost 4% of the QQQ. These are the stocks that are the most heavily weighted on the on our major indices. None of them look like they're bottoming at this point. That's the scary part right now looking at the market, is all of the leaders have turned back down. And unless we get some kind of a big beat out of the CPI, and even with it, I'm not sure the market, maybe we get a bounce short term. The Fed said we're going to need a series of these reports, not just one. So one might give us a reprieve. I don't know that one solves the issue. So I just want to point out right now, these stocks not looking particularly good. All right, let's look at earnings briefly. Going to just take a look at a couple here. One is Rivian, which reported last night after the bell. Rivian is, let's see here. Let's get the latest here. So Rivian up 8% this morning, pre-market, and you can see it's 8:18. So we got 12 minutes of that CPI report, but I'm going to be tuning out here in just 1 second. But anyway, Rivian up 8%. Let's see. CELH I saw was up this morning. That was Celsius Holdings, up 6.7%. Manulife Financial up 1.5%. Unity Software, another one of the software companies, up a little bit. So we're getting some pretty decent movement there. To the downside, or this morning, a few others that came out. TransDigm Group, which has been kind of a pretty strong stock over the last 4 or 5 weeks, not showing anything there. TPR, this is Tapestry, reported this morning. They're down almost 4%. One more, let's do AZN, AstraZeneca, up about 5% this morning, looking pretty good. Moving on quickly to the three you must see. First up is TPG. Actually, TPG made a big breakout yesterday. I like the stock, looks good on any 20-day test, maybe even down 33, 34 range. VVNT breaking out also above these tops, looks pretty good. Huge volume there. And then, of course, we need one going the other way. AFRM, big breakdown yesterday below the May low. All of those as a result of earnings. All right, that's it for me. Listen, everybody have a great day. See what happens with the CPI, and we'll go from there. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.